Welcome! In this video, we'll be discussing what is ZETA, how to trade futures on ZETA, how to trade options on ZETA, how ZETA's cross-margining system and mark pricing works. What is ZETA? ZETA is the world's first options and futures DEX, providing DeFi derivatives to enable anyone to hedge, speculate, and take opinions on a limitless variety of market movements. ZETA is the first DeFi options protocol that pairs 1. Fast under-collateralized options trading with 2. Deep liquidity, driven by a hybrid order book and unique options AMM. The protocol will enable the trading of options on a liquid non-custodial market with all the latency benefits of a centralized exchange. ZETA achieves this through the following core innovations. Fundamental Options Framework. ZETA auto-generates strikes and expiries for each option, with a seamless settlement framework to recognize profit, manage positions, and analyze risks, all on-chain. Hybrid Order Book and Options Market Maker, OMM. A hybrid order book and options market maker system facilitates deeper liquidity for all market participants. The OMM will show two-way quotes on every strike and expiry, and any participant is able to post limit orders, both of which we aggregated onto a central order book. To liquidity takers, there will be no difference between trading against the OMM and trading against another market participant. Better pricing and risk management. ZETA's OMM uses the Black-Scholes-Merton BSM pricing model to derive prices for options across all strikes. In order to quote market-driven prices and minimize any risk imbalances, ZETA uses a global volatility surface as its key input in pricing every option, which will adjust for the supply and demand of volatility. ZETA allows everyone to participate in the process of market making by depositing liquidity into the OMM pool. Leverage trading and under-collateralization. To facilitate under-collateralized trading and prevent platform over-bankruptcy, we introduce a liquidation engine to automatically flatten risky positions when market conditions demand it. With Solana's real-time block updates, ZETA is able to effectively manage platform risk in real time, allowing for leveraged trading. Ecosystem. ZETA teamed up with leading funds, trading firms, and projects to build out the ZETAverse, with partners such as Jump Capital, Race Capital, Electric Capital, Sino Global Capital, QCP Capital, Alameda Research, Ledger Prime, and many others. Before I show you how to trade futures and options on ZETA, let's first of all understand how ZETA's cross-margining system and mark pricing works. Overview of cross-margin system. What is a margin system? A margin framework unlocks the world of under-collateralized trading. Simply, margin trading is a way of using funds provided by a third party to conduct asset transactions. Compared with regular trading accounts, margin trading accounts allow traders to obtain more funds and support them in using positions. This is super desirable in the trading world, as it allows users to effectively apply leverage and use their capital in a much more efficient way. What is cross-margining? Cross-margining is an offsetting process, whereas excess margin in a trader's margin account is moved to another one of their margin accounts to satisfy maintenance margin requirements. This process allows an individual to use all of their available margin across all of their accounts. Cross-margining increases an individual's liquidity and financing flexibility by reducing margin requirements and lowering net settlements. It also prevents the unnecessary liquidation of positions, and therefore potential losses is also avoided through cross-margining. Cross-margining serves as a strong risk management tool, and it is particularly useful in volatile markets and for long-term trading strategies. For example, if a trader has $5,000 in account A with a margin requirement of $2,000 and $3,000 in account B with a margin requirement of $4,000, the client can easily satisfy the $1,000 shortfall in account B from the $3,000 excess in account A if they had a cross-margining account set up. If the trader could not cross-margin their accounts and did not have any available capital at the moment to meet the shortfall in account B, or was not able to take out the excess in account A due to a minimum account balance of $5,000, then they would have to liquidate positions in account B to reduce the margin requirement. If the trader's position at that moment were at a loss, then they would incur an unnecessary trading loss by having to close out positions before a profit could be realized. In DeFi, we have typically seen over-collateralization. This has emerged out of necessity. Blockchains have typically been slow. Often it takes minutes for a protocol to know the real state of the underlying asset price and take the actions required to keep the protocol safe and sufficiently collateralized. For an asset class as volatile as crypto, we know that these minutes can be precious. This has made it impossible to create an effective margin system. Until now. ZETA's margining system solves these problems by leveraging Solana's 400 ms block time. This allows us to update prices and monitor positions multiple times per second, enabling the implementation of a margining system which allows for an under-collateralized trading experience that rivals centralized exchanges. The key elements that factor into our margin system are mark pricing. In a world of under-collateralized trading, one of the most important inputs is knowing how much a user's position are worth. Without this knowledge, it is impossible to determine their P&L and their risk. ZETA has its own internal pricing engine, which calculates the mark price of all tradable assets and uses this to inform its margin and collateralization system. Collateral framework. This is essential for managing the capital in the system. Under-collateralized trading is all about using capital efficiently. However, as always when trading more than you have, there are more risks. The collateral framework is what ensures that this balance is maintained so that the exchange at large can continue functioning. Liquidation mechanism. The last piece of the puzzle is a liquidation mechanism, which is utilized to keep the platform from losing money. The liquidation mechanism allows liquidators to step in when a user's trading account is too risky to continue trading. When this occurs, the user is liquidated to ensure that the losses do not extend beyond isolated users. Mark pricing. Let's have an overview of the mark pricing system. Mark price is the price at which any open position is marked for the computation of unrealized P&L and liquidation. Mark price is employed to avoid unwarranted liquidations, which could result from high volatility of crypto assets. ZETA's mark pricing for futures and options are both done within ZETA's internal risk engine and are refreshed on a per-second basis. How does mark pricing work for options? A key component of pricing options is volatility. This measures how much an underlying asset moves. This is critical in options trading, as it helps project how likely an option is to be in or out of the money. The ZETA protocol maintains its own volatility surface for each expiry. For each trade that occurs between 5D and 60D, the volatility surfaces are adjusted, as there is new information that must be factored into pricing. ZETA uses the Black 76 model to price its options. This is a model based on the Nobel Prize-winning Black-Scholes Merton model. The model has the following inputs. Future price is calculated using the underlying price provided by the oracle, the risk-free rate, and the time till expiry. Volatility of the underlying asset is calculated by the volatility surface that ZETA maintains, mentioned above. Interest rate is returned from the risk-free rate curve, which is stored by ZETA. Strike is the price predefined in the contract for which to buy or sell the underlying. This is a parameter defined in the options contract. Time to expiry, calculated from the expiry time, which is a parameter defined in the options contract. Volatility surface calibration. An internal volatility surface is calibrated to each options trade on the platform occurring between 5D and 60D. Volatility smiles are independent per tenor, and values are the total implied Black-Scholes volatility between the current time and the expiry T. Volatility surface defined by a 5-point moneyness, FK surface, with nodes at 0.5/0, 75/101, 25 1.5. Surface is linearly interpolated, with volatilities 0.5 and 1.5 taking the values at 0.5/1.5. On every trade, the volatility adjustment amount is approximated as The minimum trade price, previous mark price, over the vega of options, times the minimum trade size, trade normalization factor, 5%. The volatility adjustment is applied to the two closest nodes at which the trade occurred, with only one adjustment applied if the trade is greater than 1.5 or less than 0.5. For new expiries, the new volatility surface to be initiated is a clone of the volatility surface of the expiry preceding it. How does mark pricing work for futures? In order to translate the spot price into a future price at expiry, an interest rate curve is used that is maintained natively by the ZETA protocol. Every time a futures trade occurs, the interest rate curve is adjusted, as the system now has new information about the market that should be factored into pricing. The following inputs are used to determine the futures pricing. Spot price. This is returned from the Oracle feed. Time to expiry, calculated from the expiry time, which is a parameter defined in the futures contract. Interest rate is returned from the risk-free rate curve, which is stored and maintained by the ZETA protocol. Interest rate calibration. An interest rate curve is fitted to each futures trade on the platform. Interest rate curve is defined as the total interest rate per expiry that futures are listed on. Interest rates are independent per tenor. On every trade, the interest rate adjustment amount is approximated as the minimum ln FST, current interest rate, times the minimum trade size, trade normalization factor, 2%. The interest rate adjustment is applied to the interest rate directly corresponding to the tenor of the future. For new expiries, the new interest rate value to be initiated is determined by the interest rate of the expiry preceding it. Let's go over on how to trade futures on ZETA Markets. First, connect your wallet. Then deposit the USDC into the ZETA platform. Choose the expiry market you want to trade. That is the date in which the contract will expire. Choose whether you want to buy or sell the futures. For this example, let's say we think the price of Solana will go up. So we click the Buy button. Enter the price you are willing to trade your position at. Enter the quantity of futures you want to buy. Click on the Buy or Sell button. Confirm your order. Once your order is sent, you can manage open orders and cancel orders from the Account section. How to trade options on ZETA Markets. First, connect your wallet. Then deposit the USDC into the ZETA platform. You'll see some buttons that gives you the choice between a call or put. Between these buttons, you can choose to buy a call option or sell a call option. You can choose to buy a put option or sell a put option. Enter the price you are willing to buy or sell. Enter the quantity of options you want to buy or sell. Click on the Buy or Sell button. Confirm your order. Once your order is sent, you can manage open orders and cancel orders from the Account section.